So we've got the interest burden rising rapidly. We've got the debt rising faster than GDP. So we are heading towards a situation where there is a risk, not a certainty, but there's a risk that it spirals out of control. And people are starting to see that. So what they're doing is, rather than say I'm buying gold for the keep pace with inflation, a rather dull, boring asset, Warren Buffett has said it's a pet rock which just sits there and looks at you. They're now starting to say, what if? What if this does go horribly wrong? What if the government doesn't cut spending? What if the government doesn't raise taxes? What if the situation just gets worse and worse, as seems to be happening? Well, we're at 5 minutes. It looks like we're at 5 minutes to midnight. What's my plan B? Well, I'll get some gold, because I know the gold will be there when we get to the other side of whatever's coming. So I think what's happening now is people are starting to front run the unknown. Kind of like buying an insurance. You've got a house, there's a forest fire, it may be 100 miles away, but it's coming in your direction, and you think, now's a good time to insure my house. And you don't really care that the price of insuring your house now is more expensive than it was a year before, before the fire started. You just say, I'm going to have that insurance whatever happens, because the consequence of things going wrong would be disastrous to me. So
hey everyone, my name is Anthony Fatsies, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Clive Thompson. So Clive has vast amounts of experience in the wealth management industry and has a unique insights into what's happening in central banks. He's also got a very successful channel where he shares a lot of his opinions on there as well. So Clive, thanks so much for coming back on the podcast.
Well, hello, Anthony, and thank you very much for inviting me back. It's been a really busy couple of months, especially in the precious metal area. I think that's where everybody's attention has gone in the last month or two.
Yeah, it definitely seems to be the case. And as you said, it's been a volatile ride. But where I'd like to start with as I start with all my interviews, is what are you currently seeing in the markets and the economy, and what are you focusing on?
Well, the stock market, whilst it looks like it's having a bit of a wobble at the moment, has consistently remained strong throughout all of last year, and actually for multiple years, despite the ongoing predictions, which we hear all the time, of a crash. And you may remember that when we had Independence Day, when was it April last year, that for many commentators was the end of the stock market, because they're putting in place the tariffs, and suddenly the whole of world trade was going to slow down. The stock market did crash, but the crash lasted a day or two, and then it was back up to new all-time highs. And I think what this is reflecting globally is the fact that there is, on an ongoing basis, more money in the hands of the wealth gatherers. We constantly have situations in the Western governments of them borrowing money to fund their deficits, and to pay the interest on their national debt, and to repay the maturing debt. So the debt just gets bigger and bigger, or let's put it another way, the governments get poorer and poorer. And someone gets that money as the government gets poorer, or someone gets richer, because someone's going to hold the government bond, the bonds that the government issues to borrow the money. So someone's going to hold those bonds. And so out there we have a population who are in some way, shape or form getting richer. Now, of course, it's not everybody. That wealth, that money which is being created, gravitates to the let's say the top 20 or 30% or 15% maybe, because they are the real producers. They're inventing things. They're the business owners, they're the company owners, and they of course don't go out and push up the consumer price index when they've got more money. They don't go and buy everything that we would buy as consumers, so there's no more supply left, so the price, so that we don't have demand pull coming from them. What they do, they take this extra wealth that they now have and divvy it up across the different asset classes depending on the mood of the day. So that could, of course, be some of it left in treasury bonds and bills and so forth, and it could be bank deposits as well. But at the end of the day, their asset allocation, if they're richer, they're going to probably have a little bit more of everything. So that does push up gold, silver, equities, property, collectibles, works of art, and just about anything else that's out there on the planet that is in limited supply and that rich people want to own.
Okay, yeah, really interesting. I guess that's the issue we've seen over the past, couple of years with interest rates going up, with inflation going up, and there's actually been quite a lot of wealth destruction in the bond market, where a lot of these wealthy people were holding the assets. Is that what you saw, or do you think now they actually have a yield, so they're benefiting from it? How do you gauge that trend?
So we've seen. I mean, yields have been a little bit up and down. I mean, the most important thing to say is that the yield on the longer dated bonds, I guess I would describe it as slightly creeping up. It's not been falling as we've had these 3 interest rate cuts last year from the Federal Reserve. So although short-term rates went down, the longer-term rates were not reacting positively to that. The yields were going up, bond prices were going down slightly, and again, it wasn't dramatically. I think if we were to see the yield on the long bond go to, say, 5.5% compared with, say, the 4.5% we're at now, then we would probably see a very significant fall in the bond price, maybe as much as 25 or 30%. But the changes we've seen in the bond yield, it just depends on your starting date. If you look back over the last year, I can find days when the yield was a little bit higher, and I can find days when it was a little bit lower. So I'm not really saying that anything's happening yet, but I think we are on the cusp of seeing yields go up and bond prices go down. And the longer dated your bond is, the more likely you are to take a capital loss on the price. Of course, your coupon won't change, but your coupon might look less attractive when you compare it with the future debasement of the currency and potentially inflation rate. And when I say inflation, I do not mean the CPI. I mean the inflation rate as it applies to you personally in respect to the things that you want to buy over the long term. The reason you're saving, are you saving to pay for your grandchildren's houses? Are you saving to pay for your medical expenses? Are you saving because you want to go on an expensive cruise, or do you want to go into a luxurious retirement home? All of these things have higher inflation rates than the price of pizzas and peas and chickens.
Yes, very, very, very true. And you said there at the start of the conversation, I guess, that the wealthy are, so I guess, diversifying their money. They're trying to find places that they can, make a return. And it seems like precious metals has been that place currently. Is that because they are concerned about what's happening with government debt and other parts, or do you think they're just being opportunistic and seeing this massive, blow off top that we've seen?
Traditionally, precious metals didn't play much of a role in the portfolios because the general view over the last few decades really has been all you could expect from precious metals is that they'll keep pace with inflation. They'll maintain their buying power over the long term, over centuries. And the general view was you could get a better return in other things like equities or even government bonds or deposits, at least if you were not paying taxes, that is. So it wasn't much of an asset class over the last few decades. I mean, when I started in Switzerland, we did have, that's 40 odd years ago, we did have about 5% as a standard exposure to gold in most discretionary portfolios, but that number went down over the years. So by the time I'd retired, that's about 4 years ago, at 65 years old, the exposure to gold in portfolio was across the board very close to zero, unless the bank had a discussion with a client and said you should put gold in the portfolio, as I actually did. So there was probably not one of my clients who hadn't agreed that we should have some gold, which now I think about it has probably served them very well. But it was, if you look at the official asset allocation of the banks in general, when I retired, it was mostly zero in gold. In fact, it wasn't even featured. It wasn't there. Now, banks and financial institutions are starting to add gold as an asset allocation, and we're seeing it coming back a bit. But it doesn't mean to say that most portfolios have gold in them. I don't know what percentage of global portfolios have have gold in them, but perhaps the ones which are allowed to have gold, because don't forget many portfolios couldn't, perhaps the ones which are permitted to have gold have an average of maybe 1%. That's just a guess. I don't have a hard statistic on that. But many portfolios can't own gold. For example, if you have an ETF tracking a particular equity index, it can't own gold. If you have a trust or a foundation which has got some bylaws which specify how the money is going to be invested, it can't have gold. So there's many types of if you have a Luxembourg insurance policy, for example, it's not allowed to have gold by law. So there's many types of portfolios which can't have gold, but those which could have gold, I still think the figure is pretty low, with exceptions where some will be at 5 or 10%. But one of the things which has been driving the gold price, apart from the ongoing central bank buying, I think has been the change of attitude amongst the man in the street, Joe Public. People have started to realize that the days of low inflation fiat currencies, and I come back to my definition of inflation before, not the CPI, those days of low inflation are numbered, and we might be going into a very high inflation environment because of the levels of government debt. The problem with government debt being that it is expanding and continues to expand much faster than the economy is expanding. So it's expanding faster than GDP in absolute amount. And the interest burden on that debt is expanding considerably faster than the debt is expanding, because not only are they piling interest upon interest in terms of what they have to borrow, but the interest rates they're having to pay are generally much higher than the interest rates that they were paying over the last 10 or 15 years since the global financial crisis. Don't forget, after the global financial crisis, interest rates around the world effectively went to zero, or pretty close to zero, which meant that governments were borrowing at very low interest rates. But as that debt matures, that low interest rate debt still has to be refreshed, but it can't be refreshed at that same interest rate. They have to borrow the new money at a much higher rate. So we've got the interest burden rising rapidly. We've got the debt rising faster than GDP. So we are heading towards a situation where there is a risk, not a certainty, but there's a risk that it spirals out of control. And people are starting to see that. So what they're doing is, rather than say I'm buying gold for the keep pace with inflation, a rather dull, boring asset, Warren Buffett has said it's a pet rock which just sits there and looks at you. They're now starting to say, what if? What if this does go horribly wrong? What if the government doesn't cut spending? What if the government doesn't raise taxes? What if the situation just gets worse and worse, as seems to be happening? Well, we're at 5 minutes. It looks like we're at 5 minutes to midnight. What's my plan B? Well, I'll get some gold, because I know the gold will be there when we get to the other side of whatever's coming. Don't know what's coming. It could be, it could be a bail-in, it could be a hyperinflation, it could be just high inflation, it could be it's unlikely to be a default. It could be some capital controls, it could be an alternative currency being issued, it could be ration coupons. There's many potential scenarios where some rather drastic action might be taken to rein in the let's say, a financial crisis for the government. It might be a situation where people are forced to lend money to the government at a certain rate. All pension funds have to invest 70% of the money in government bonds. They can think of whatever rules they like. And people are starting to say, well, I need a plan B to get to the other side, because I don't know what's coming. So I think what's happening now is people are starting to front run the unknown. Kind of like buying an insurance. You've got a house, there's a forest fire, it may be 100 miles away, but it's coming in your direction, and you think, now's a good time to insure my house. And you don't really care that the price of insuring your house now is more expensive than it was a year before, before the fire started. You just say, I'm going to have that insurance whatever happens, because the consequence of things going wrong would be disastrous for me. So I think people are now rushing to front run a future which we don't know if it will happen, but a future which is certainly seen by many as possible. And so that's why they're going for the gold. But now that brings me to the silver, because of course silver is the poor man's gold, so they say. The price is considerably less. You could get you get 50 ounces of silver for 1 ounce of gold, roughly. What does that mean? It means that the silver is much more divisible and much more usable for smaller transactions than gold is. So if you see or fear that the currency system is going to break down, you probably want to have the smaller items that other people are going to accept, because it's you can't go and buy a loaf of bread with an ounce of gold costing nearly $5,000 today. And of course, in a currency breakdown, it won't be $5,000. It'll be so sought after that you can't imagine how high the price would be, and nobody's going to. So you don't want to be spending that on your loaf of bread. So that's why I think people are now starting to say, as well as gold for the long-term savings for the bulky stuff, I need to have a lot of silver just in case. Again, they're not buying it. We're not talking about the paper silver, which is bought through the ETFs. They're buying the physical coins and bars. They're saying, I want to have this physical physical bars and physical coins of small size, so that if the brown stuff hits the fan, I can go and negotiate these for all kinds of things. I can change it. I can change my gold and my silver, especially for tools, for food, for my daily needs, if we're in a situation where that's the only thing people are willing to take.
Yeah, as you say, it's sort of basically a call option on the unknown and what's going to happen. And I think the challenge is everyone was hoping when Trump came in, DOGE, maybe there was going to be a shift away from these continuingly increasing deficits, but that's obviously not the case, and it doesn't seem like any country can find a way to cut their current deficits, and then the US might be able to grow out of it, but no other country has anywhere near the growth to actually be able to do that.
Yeah, I mean, you could imagine, Elon Musk with his task of cutting government expenditure, for all his efforts, it was incredibly hard. It's not a task I would have taken on, because you've got everybody in every department against what you're trying to achieve. So it's almost, unless you're an outright dictator with all the power, it's almost impossible to achieve the cuts that you want, because every department of every government, they all want a bigger share of the money, and why not have 3 secretaries instead of 2? That's kind of how people think. So he was, he was fighting an army of people who were not willing to go with the flow. And of course, politically, some of the things he was doing were perceived also as unacceptable by the administration around him. It's all very well saying, the administration saying, we want to cut expenses, but what happens when you really do cut expenses and people, your voters, your contributors stand up and say, hang on a minute, we voted you in, we didn't expect you to target us, can't you go and target somebody else?
Yeah, and I think they these institutions realize that if they hold off, if they fight for as long as possible, if they try and prevent, that in a couple of years if they can survive a couple of years, someone else will come in and be able to, it will stop. So I think that's a challenge with a lot of these institutions, especially government institutions. They basically just prevent as much for as long as possible until either people give up or the administration changes. But I mentioned their U.S. economic strength, but you were talking before we sort of started the interview that you actually saw the employment data recently, and you thought it looked quite abnormal. So be interested. So do you actually maybe not think that the U.S. economy is as strong as it's sort of the data is suggesting?
Well, if I could just share a screen with you, when the employment numbers come out from the Bureau of Labor Statistics, I typically screenshot the data. And as those who follow the numbers will know that month after month, year after year, we hear that there's been net new jobs. I think it was 50,000 or something this time. But it seems that we have a non-stop stream of job creation, which is quite normal in an economy where the population is growing. And I'm going to show you this in a second on the screen. According to my screenshots, the actual number of employed people doesn't seem to be rising, at least not according to the government's own numbers. So if I can just figure out how to share this with you. So according to this is 4 screenshots over 4 years or 3 years and January of the non-farm payroll number. Not the number of new jobs, it's the actual number of people employed according to the government. So according to the screenshot I took of the December 2024 number, that's 2 years ago, or 1 year and a bit ago, in December 24, there was 159 million people employed. In fact, it was 159.9. So let's call it that number here. Let's call it 160 million people were employed. Stop that. My phone's ringing. 160 million employed. I look today, and here's the number in January 2026. It's 158 million. So it's gone down from 159.5 million to 158.6 million. So it's down very approximately by 900,000 people. So as of today, in January, the January number, official number, this is the government's own number from their website, 900,000 people less are at work than there were a year and a month ago in December 2024. Yet every month we've had this positive number showing lots of new employees. So what's going on here? To get to this positive number of new employees, of people, more people working, they've been adjusting the old numbers backwards and downwards. They've been over the last few years. I checked the numbers. They've adjusted it down by 900,000. So we've got 900,000 in a year and a month, less people at work. But what's happened to the population? And I'll just bring that up very quickly. If we go to the same date, December 2024, we had, according to their numbers, we had 269.3 million people in the United States. According to their own numbers, we now have 274.9 million. That's an increase in population of 5.6 million. So what we've got here is an increase in population of 5.6 million, but nearly 1 million less people working. So I was quite surprised. I wasn't surprised, because actually this tactic of saying we've got a positive jobs number has been going on for years and years. They consistently revise down the old numbers, which always makes the new number look better. So that was just what I wanted to show you.
Yeah, it's interesting. I guess the challenge is how they measure unemployment as well, or employment, is that if someone is unemployed for a certain period of time, or if they're not looking for work, they just basically remove them from that measure. I think that's something that we're seeing.
We on this line, you do see an unemployment number. A year ago, the number of unemployed was that's the official number. Don't forget, there's a lot of people who are not classified as unemployed for various reasons, perhaps because they've given up and said, look, no point in me looking for a job. There's no jobs around here. But the officially unemployed was, a year and a month ago, 6.88 million. And if we go to today's number, the one which has just been announced, the number of unemployed is 7.36 million. So a good 500,000 unemployed more than there was a year and a month ago. I just can't help smiling a little bit at the how the numbers can come out every month with a positive spin, when if you look at the hard data, it doesn't stand up.
Yeah, and what do you think this means for the economy? Is it that maybe the strong data is sort of misleading, or do you think maybe the GDP growth is actually disconnected from employment because of AI and other trends? Yes. And maybe there's, you think that's the case?
The latter. We've got a two-speed economy. We've got a large number of people who are struggling a lot, to the point where they've had to give up looking for a job or draw benefits for unemployment, because it's hard to put food on the table for their children and pay for education, all the other things that they've got, the mortgage and the rent. And then you've got another group of people who are in the highly paid jobs, and quite often husband and wife working, which is almost a necessity these days. And they're doing all right. So that's probably sort of a 30-70 split, where the 70 are struggling and the 30 are doing okay. But the 30 who are doing okay are benefiting from this growing economy. We've got we've got money still being thrown at the economy by the government as they borrow money and then spend it on other things. So the money is constantly being pushed into the economy by the government as they spend it, and that does help boost the GDP to some extent. Obviously, a lot of that just gets consumed and wasted. But AI, as an example, is going to be of is starting to be a benefit, but it's going to be a much bigger benefit in the future. So it's entirely possible that GDP could continue to grow at a faster and faster pace. I heard a figure of something like 5% for the last quarter in America, which was amazing. But GDP could grow at a pretty brisk pace, whilst there's less jobs out there for people who want to go to work.
Yeah, it's going to be really interesting. You imagine it have quite social impacts if this continues to be the case, and then the only solution seems to be universal income, or maybe shift away from how we currently see work and more, basically the attention economy seems to be a place where that might truly benefit. And
Well, I do feel ultimately we'll get to the situation of universal basic income. Artificial intelligence is progressing at an incredible pace, and everywhere I talk to a lot of professional people, and it seems that vast majority of firms are pretty much at the early stages of harnessing it. They're experimenting it in some departments. They're worried about the security aspects in others, but it's coming. But I spoke with one of my friends who works for one of the largest companies in the world, a very large company with big offices here in Switzerland. He said, unofficially, this large company expects to lose 10% of their staff in the next 12 months, thanks to AI, because some of the tasks will now be done by AI instead of humans. And in some cases, they won't need half as many people in the team to do the work of the team anymore, because they only need a couple of people who know how to harness the power of the AI. They don't need everybody doing it the old way.
Yeah, and that's amazing to think. So if we go back to gold and silver, do you see what we saw as sort of the major top, and now we're getting a reversal, or how are you currently looking at the recent bull run we've seen?
Well, I think we're trading. We've had this what turned out to be a speculative blow off. I mean, it's not necessarily a top, but it looked like a top, because when we had the announcement of Kevin Warsh being appointed as the new chairman of the Federal Reserve to replace Jerome Powell when he retires in May, Kevin Warsh was seen as a surprise in terms of what people knew about him, because when people looked him up, they found that he was a person who could be a staunch defender of the Federal Reserve's independence, and the kind of person who probably wouldn't agree with quantitative easing. And that was based on his tenure as a board member on the Fed back in 2011. And we'll find out if that's really the case. But I think that was the spark which lit the fire. So if you think about a forest that's full of very, very dry wood, you never know when it's going to burn, but it's been there for a long time. The wood's dry, getting drier and drier, and then suddenly there's a spark and the flames spread. So that was the spark. But what caused the flames to spread? What caused this cascade of selling? Well, as the price of silver, especially, rose rapidly, a lot of people entered the market using CFDs, that's contracts for difference, which obviously lay off their risk in COMEX and other places like that. But when you do CFDs, you typically have a 10-to-1 leverage ratio. You can use more or less depending on where you do the business, which means that the CFD provider, and this would apply also to people trading futures, but in a slightly different way, the CFD provider is going to put in place an automatic stop loss, whether you like it or not. That stop loss might be adjusted according to how leveraged you are, how much money you've got in the account, and other factors. But in general, when people are trading CFDs, they're trading on a leverage basis. And we had people all around the world doing that. And ultimately, those risks are laid off via COMEX and other places with what's called stop losses. Stop losses are trigger points, price levels at which a position will be automatically closed. And if we're talking about someone who's long, closed means they sell their position if the price goes below a certain level. And the reason the CFD companies or betting companies do this is to make sure they never get into a situation of a loss. So as the price starts to decline a little bit towards the level where the CFD company could lose money, or on COMEX where the broker could lose money because his client has got a position, they will say either to the client, stump up more money, and that's and typically you have to stump it up immediately to make sure you're covered for after the price decline, or more likely, especially in the case of the contract for different sites, it's a stop loss, which is a hard one, which will be automatically triggered at, let's say, 5 or 7% away from the. Let's say you've got 7% running, and the price has gone down by a couple of percent. You're immediately getting too close to the point where you're losing money, and it'll automatically trigger the stop loss. So each stop loss, as it's triggered, causes an instant sale. Now, that sale doesn't automatically happen at the stop loss price. It happens at the next price traded after the stop loss has been touched by somebody else. Now, in a normal market, that often means you get the stop loss price because there's an army of people willing to sell a certain price. So the first one sells at the stop loss price, but there's an army of people willing to buy at the stop loss. So it touches that, but you can come in second, third, fourth and get the stop loss price too. But in a fast moving market, especially the one we've seen, there won't be so many buyers sitting there to absorb your order. So when your order goes through, someone touches, let's say $110, which was your stop loss, your next trade, you'll get the next trade, which might not be at $110. It might be $109.95. But of course, there's going to be another person with a stop loss at $109.95. So his stop loss gets triggered and he gets traded at, let's say, $109.85. And guess what? There's another person behind that with a stop loss of $109.85. And so it goes off. So we then have this cascading series of stop losses, each one creating a sale, driving the price a little bit lower, which then triggers the next one below, and so on. And of course, there would have been millions of these stop losses sitting around in different places all around the world. And obviously, a lot of people got the money they had in their CFD accounts effectively mostly wiped out by that fall. And of course, they're all sitting there burned. So what we're doing now, we're sort of, I think the price went down to, I can't remember how low it got now. Was it 60 or something at one point, 70? Yeah, maybe, I don't know where it was, because it was such a fast moving market, nobody really watched it. And we're sitting in the mid 80s now. So we're well below the top, which was like $123 on silver, and we're somewhat above the bottom of the range, although I would say we're closer to the bottom of the range than the top of the range at the moment. So what's going to happen is that the silver will trade in that inside that band of the top and bottom for a while, and then at some point it will break out to one side or the other. And if it breaks out to the downside, I think we probably go as low as 50, probably. That's just a guess. I don't know that. And if we break out to the upside, I think it's on the way to, well, much higher levels. I would say 150, maybe even $200.
Yeah, okay, really interesting. So you don't have one or the other perspective. You just think it's very much depends on the range. And,
well,
and yeah,
I prefer to go with a longer term view, which is the supply-demand imbalance and the geopolitical situation and the uncertainty around the world, which means that, in my opinion, the demand for silver is going to continue, not only from industrial users, but it's also going to continue from investors who will say, I'm going to go down and buy myself a few silver coins just because I want to get started. So I think that's going to continue. So I'd rather go for the upside. But of course, this is not supposed to be investment advice. It's just a personal opinion of what I think is more likely. But it's not going to, it's not going to be a straight line. We've got a long period now of sitting in this range. It's going to struggle. Every time it goes up a bit, there will be people who jump on board saying, oh, it's on its way up. But equally, there'll be people who say, I should have sold at 120. Okay, I'm happy to accept 110, and they'll sell out. So we've got this pressure. As we go higher price, the pressure, a number of people are willing to sell at those higher prices increases. But as we go lower, a lot of people have missed the boat who will say, I wish I could have bought at the bottom. So we kind of probably stay in this range, between the top and bottom of the recent swing. But once we break out, that kind of tells you the direction, and then you have to listen to what the market's saying about itself and take action, i.e. sell it. If it's selling, sell into it. And if it's buying, jump on board quickly.
Yeah, interesting. And I think one interesting phenomenon we saw with physical, I guess, gold and silver is that actually, if you're trying to sell it close to the tops, it was sort of quite a large discount. I think, sometimes 30% discount from trying to sell physical versus the actual price. So is that just, as you said, opportunistic people trying to sell, or does that maybe put into question whether you should actually own sort of physical precious metals?
Yeah, well, a lot of people have made the mistake of thinking that the way to trade precious metals is to buy physical gold or silver, and then when the price has gone up, to sell it. That's not what people should be doing. They should be buying the physical metal because they want to have something they can keep forever, a parachute, an emergency fund, and something which will hold its value over the very long term, and hold its value in a way where you do not need permission from anybody else to touch it or take it or use it. That's physical for you. And given the way the world is going with all kinds of geopolitics and bank seizures and sanctions and all kinds of things, I can see that the number of people who'd like to have something outside of the financial system is not going to go down. So that's the positive side. But you shouldn't be doing that thinking, gosh, I'm going to, if it goes up, I'll sell it. I'll buy some insurance today, but if that forest fire gets closer, I'll sell it and make a profit. It's like being on the Titanic, right? You're on the Titanic, and there's only a certain number of life jackets, and you happen to own a life jacket, and the price, and then it hits the iceberg, and the price of life jackets goes up because there aren't enough for everybody. So you say, great, I'll sell my life jacket at the higher price, but then the water starts coming in the ship, and you want to buy your life jacket back. What do you do? Well, you might get to the point where nobody's going to sell it to you. So it's like that with gold and silver. You don't know. You shouldn't be trading it. You shouldn't be buying and selling it based on the price, because if at the end of the day, you're keeping it for the disaster. And maybe to pass down to the generations. You shouldn't be keeping the physical to trade. If you want to trade physical, if you want to trade to make a profit, the way to trade to make a profit is to trade the futures or trade the ETFs. Of course, you're trading paper, and I'm not saying to people you should own paper, because that's not what I'm talking about. I'm saying if you plan to buy today, hoping to sell tomorrow, paper's the way to go, because there's almost no difference between the buy and ask spread price if you're buying an ETF, and almost no commission if you're buying enough size. So you can buy today and sell tomorrow and make a profit, provided the price went in the right direction. You certainly can't do that if you own physical coins or bars, because when you buy physical coins or bars, you've got a dealer markup, which covers the cost of making the coin, it covers the rent, it covers the distribution costs, and it covers the dealer's time and everything which goes with it. So you're paying well over the odds for the silver or gold content, and in times of stress, that premium will increase. But you go and try and sell it back to the dealer, he's not going to pay you more than usually not much more than the gold price, if at all, or much more than the silver price. Of course, you could sell it privately if you wanted to, and probably capture roughly the same sort of premium. But the trouble with that is you've got to find a buyer somewhere. and that's not so evident, and it's got all the risks which go with it, unless you're dealing with a trusted counterparty. So, obviously, if you go back to the dealer, there is the convenience that you just go to one place and he's going to take it off you. He's going to give you a price, but you might not like the price, but at least he's always there for you. But as I say, the price at which he'll sell to you will always be somewhat higher than the price at which he'll buy back on the same day. So that's, I don't ever say people should buy physical to trade, but of course some people have held the physical for 5 or 10 years, and they've got these monster boxes of 500 coins, and they're saying, "Wow, it's 3 times what I paid. I will take the money off the table." And the fact that when they bought it, they paid 5% or 10% too much doesn't matter when it's gone up 300% or 200%. They say, so what if I paid 10% too much? It doesn't matter. I'm out of here. I'm going to take the money and tell everybody how clever I am to have bought it.
Yeah, very true. And thanks for explaining that to us. So, Clive, thanks so much for your time today. We sort of covered so many different topics and gone in different directions. But my last question is, what is one message you want people to take away from our conversation?
Well, since we last met, Anthony, I have actually set up my own website. It's clivethompson.com. And you're welcome to go and have a look around there. There's some of my videos which are on YouTube. I've got a YouTube channel called clivethompson.com, and anyone who wants to contact me can get in touch with me via LinkedIn. I've got a lot of requests coming in for different types of, I won't call it advice, but people are sounding me out to see if they're going in the right direction with their investments. I never advise anybody to put all their eggs in one basket. I think that diversification is the great thing. But of course, if you're very young, like you just got your first salary and you can afford to take a bet, well, why not take a bet on something you're very convinced of? But as you get older, you need to have more and more different types of investments and more different exposures to different asset classes, so that you're not beholden to just one of them.
Yeah, it's a great message. Clive, thanks again. And yeah, you mentioned your YouTube channel and your website, so I'll put that on the description below if anyone wants to sort of see more what you do or contact you. But thanks again for your time.
Thank you, Andy. Bye-bye now.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.